because you have some definitive feelings about yesterday's move, and even though it looked like some of these nagging problems were being addressed yesterday, there are still quite a few uncertainties. So you think that it was maybe a head fake that may not necessarily just keep extending higher and higher. Is that correct?
Yeah, I think that's right. As I've articulated on the show before, there are four things that I was looking for resolution on to gain greater confidence. The election, the stimulus, COVID numbers, and a vaccine. With the election, we're not out of the woods yet, and that affects the stimulus. To the extent that we have two parties well entrenched on each side, that we haven't acknowledged, that we haven't unanimously acknowledged a winner and allowed a transition to take place, that obviously is going to put some unrest into the market eventually. But more importantly, this is absorbing all of the political bandwidth. It's taking all of the political oxygen out of the room. And while this is going on, I doubt we hear anything about the stimulus that our economy needs. In terms of vaccine, you guys have heard me argue before that when we have these announcements, they're going to provide little mini rallies. I expect that to be the case as we hear other announcements this month from Moderna and Lilly and the like. Albeit probably in decreasing magnitude. But while we have 1 million cases being diagnosed almost every week, while we have the equivalent of 2 or 3 9/11s and deaths every week, we can't use these announcements to pinpoint a bottom yet. And so what we need is either to get a better grip on the spread and or have a commercial viability announcement, have a approval, and this is going to start production next week. Right. That's when we can call a bottom. That's when we can say the worst is behind us. I'm going
to go to Paul quickly and come back to you, Greg, because now we understand how you feel. I want to know whether that actually means you're going to tell clients to do something or not with it, because a market that goes from 10,000 20 years ago to 30,000, you might once in a while get more liquid to buy next time it goes down a little, but you could ask yourself, should we be taking profits every point from 10,000 to 30,000? And obviously, if it's going higher in the next 20 years, there are times you want to enter it, but I don't know whether that's whether that's a good way to think about it, when you should actually en masse take profits, because then you're talking about you think there's a bear market. Paul, what do you think?
So, I think we've been spending a lot of time focusing on the outcome of the election, what's going to happen, and such. And I think when we focus so much on it that we sort of, lose sight of the bigger picture of things. If you look back, you look at the market now, you've seen tech, communication services, healthcare, and consumer discretionary outperform since election day. And most people think that Biden's going to be the next president of the United States. I think most people can agree on that. So I think people are thinking, are these the sectors that are going to outperform going forward in the next 4 years? But you only have to look back 4 years ago, when in the initial days after the 2016 election, you saw financials, industrials, materials, and healthcare outperform. Everyone thought those would be the big winners under a Trump administration. Guess what? All 4 of those sectors underperformed the market in the following 4 years. And the only 2 sectors that outperformed the market were technology and consumer discretionary, both of which underperformed in the initial reaction. Right. So I think the first impressions get a little bit, we make a little bit too much of them. And, the longer term impact is that who is in the White House isn't necessarily as important on the market as to the secular trends in place within the economy.
Shepard Smith here. Thanks for watching CNBC on YouTube.